Wow, wow, wow. Today was quite the Fed day. This is the most momentous Fed day in recent memory. Uh, I will admit, first off, I was wrong. I went against market expectations and I said, you know what? No, the Fed's going to pause. Yes, the market was pricing in 25 basis point rate hike. And yes, Powell tends to go with whatever the markets expect. But I just thought it made so much more sense for them to pause. Not because I think that's the right thing to do, but because I would think from their perspective that's the right thing to do. At this rate, the Fed is going to look like idiots when they inevitably cut rates because we're in the midst of a financial crisis. When on this day, March, what is it, the 22nd, in the year of our Lord 2023, they hiked by an additional 25 basis points, and Powell, well, I'll get to it later. I don't want to spoil anything. But that's the headline for you. But as always on Fed Day, the most interesting tidbits come from Powell's Q&A session that he does after reading, the scripted Fed statement. And it was during this Q&A session that, to me, it came across that Powell is still very, very hawkish. In fact, he sounded more hawkish than ever on inflation. He's even still talking about how the costs of, letting inflation run hot are much higher than the costs of bringing down inflation. And he pretty much said they remained committed to bringing inflation back down to 2%. They didn't raise the inflation target, which I'm happy about, by the way. I'm not knocking Powell for this. I'm just surprised. And, he's leaving the door open to more rate hikes in the future. But the most significant, the most perhaps catastrophic for equity markets and surprising thing that I heard out of Powell today was that I don't think that this is truly what he did, but based on what he said, you would think that Powell closed the door on rate cuts. He was asked point blank, are there going to be any rate cuts this year? Do you see that as a possibility? And he said that's not our base case. And he even said more than that. He made it pretty clear that the Fed has zero intention of cutting rates at all in 2023. If anything, they're going to hike rates. He did say they considered pausing briefly, but determined that inflation was still running hot and that unemployment was not at all a concern. Employment was still quite strong, and inflation is also quite strong. So Powell and the other Fed folks, they switched from leaning towards pivoting towards wanting to hike by another 25 basis points. This to me is nuts. Again, I'm glad they're doing it. But if you are someone whose job it is to preserve the system and you want to preserve the status quo and you want to salvage everything that has been built, you're not hiking rates right now. Hiking rates is what you do if you're a crazy like me and you want to watch the financial system, the financial fraudulent house of cards come crashing down. Because, always when the Fed is hiking rates, when the Fed enters a hiking cycle, they always hike until they break something. Well, guess what? The Fed already broke something. And that something was not just Silicon Valley Bank, Signature Bank, Silvergate, and Credit Suisse. Those four banks are just the beginning. If those four have already gone under, First Republic always teetering on the edge, there's a lot of other banks like them. They weren't that unique. Yes, Powell pretty much, he tried to write off Silicon Valley Bank as a fluke, as a one-off. He said, look, they had a significantly high percentage of uninsured deposits, which is true. 88% of their deposits, or 88% of the accounts, I believe, were uninsured, meaning they were, this was a bank that catered to big clients who were way over $250,000. That's not usual. Most banks cater to people who are under the $250,000 FDIC insurance limit. And this bank did not hedge for interest rate risk. I mean, those are valid points, okay? But you want to tell me that every other bank in America is hedged for interest rate risk? I don't think that's the case, because every time that interest rates start going up instead of perpetually going down, the financial system starts to come unglued, and then the Fed has to run in and save the day. This has been true for my entire life, and it's been true going back into the mists of history. When interest rates rise, banks and other, financial players, they start to go bankrupt. That's just the nature of the game. And so I have no doubt at this point that we're going to see more banks going under. And maybe after that, then the Fed will announce that they're going to pause. But I mean, come on. The idea that rate cuts are not in their base cases unreal. There is no, I will tell you right now, and I make predictions on this channel, and I'm wrong a lot of the times, and sometimes, other times I'm right, and I always lead with when I'm wrong, when I've been proven wrong about something. But I feel pretty confident saying right here, right now, the 22nd of March, the year of our Lord 2023, that before year's end, before January 1st, 2024, the Fed is going to cut rates. There is no way we get through 2023 without the Fed cutting rates. And so whatever shred of credibility the Fed had left should be gone after this, but of course it never is, because no matter how much the Fed destroys its own credibility, it's not like they have any competitors. We're not allowed to have competing currencies in this country. In fact, that's why you have all these red states who are trying to pass laws, forcing the Fed coin, the central bank digital currency, down our throats. Thankfully, we have DeSantis standing up against that. But we'll see if the Florida legislature, goes along with it. But again, that's all besides the point. That's not right here, right now. What we're dealing with right now is an ongoing financial crisis that is going to continue. So, in addition to that, there was a couple of other interesting things that Powell said. Simon Rabinowitz of The Economist asked Powell to elaborate on something that he said in the statement. He said that depositors should feel confident, that the money that they have in the bank, will be there when they need it. And he asked Powell straight up, "Hey, are you implying that everyone in every bank across the country, will have their deposits backed up, 100%. Is that what you're saying right now? Is that there's no more, FDIC limit?" And Powell did not say no to that at all. He dodged, he stumbled, he mumbled. He went, "Well, I didn't say anything except what I said." And that's that, people should have, and I can't even repeat what Powell said because it was a bunch of gibberish, but at the end of it, it sounded to me like Powell was saying yes without saying yes. It sounded to me like he was saying, what he said was, we've already proven that we have the tools to back up, depositors. So what he's saying is that if your bank goes under, we're going to bail you out. And that's pretty significant. The Fed, to me, sounded like today, they didn't want to totally say it, but that was the message that Powell was trying to send. Certainly he wanted to send the message that if your bank goes under, we got your back. So don't pull your money out of the bank, is the underlying implication of that. But little does Powell know, or maybe he does know, when banks do start to go under, he's going to be put to the test on that. And we're going to see the Fed, I guess, just start to bail out every single bank and all the depositors. But then at the same time, Powell kept, and he made this point multiple times, he was talking about how if, we have credit tightens, meaning, banks stop lending out so much money, there will be less of a need for the Fed to hike rates because, the point of the Fed hiking rates is to essentially tighten credit and, reduce inflation. Because credit expansion is by nature inflationary. It's the creation of money and the injection of it into the economy. And so if banks stop creating so much money, well then the Fed doesn't need to hike rates. So essentially what Powell's saying is that we need the banking system to break down, we need banks to stop loaning money out, or we need banks to go out of business, and then we don't have to cut rates anymore. But until that happens, until the banking system ceases to operate, essentially, we are going to keep hiking rates. So under that scenario, a financial crisis sounds like it's a positive thing for the Fed. Because if you have a bunch of banks go under, well then look at all the collapse in the money supply. Look at how much credit is going to tighten. Banks are going to be pretty tight with their wallets, and they're going to keep a lot of reserves. And so, I was actually a little surprised. I was watching the stock market at the same time Powell was talking. I was thinking about, like, how are the stocks still up? And then literally, then I go and check a few minutes later, and it was through the in the toilet, had given up all the gains of the day. And there was like on the S&P, I think like a 50-point reversal or something. And I think the Dow, there was something like an 800-point reversal, was up like 300 and ended up down 500. And then of course you had ARK and Cathie Wood, and they were down like over 4%. ARK, ARK Investments, they're now our hometown heroes since they moved to Florida, specifically to the West Coast. St. Petersburg, I think, is where Cathie Wood moved her firm. Crazy cat lady. So anyway, Powell has essentially turned into the Hellfire Elmo meme, and I'm not complaining. This will make things more interesting. They're not playing the hero yet, so I wonder how bad things will have to get before the Fed comes in and rides to the rescue. But then again, they're doing QE at the same time as as they're hiking rates now. And Powell said, oh, don't worry, that's temporary, so we're not going to call that QE. We didn't just undo however many billions in QT. And so if you consider that the Fed is expanding the balance sheet at the same time as hiking rates, is it a wash? Maybe not. But anyway, with that said, I will see you folks back here tomorrow.